Good morning, everyone. Welcome back. This is our final class. So today we'll be going all in on this final pillar of financial literacy, investing. So we have a lot to cover today. So let's just jump right into it. And the first thing we're going to look at is actually going back and looking at day 4 work. So let's start there. So I think 20 people have submitted this already, so it's pretty good compared to previous days. But I hope that more of you can get these in on time, so then you can test yourself and try to figure out whether you're understanding the class or not and understanding the content. But let's start with the first question. So, true or false? Are auto loans secured by collateral? Auto loans are secured by collateral. And this is true, right? Because for auto loans, the collateral is, can anyone finish my sentence? Raise your hand. Does anyone know what the collateral is for auto loans? Ella?
I think it's the car.
Yeah, it is the car. Good job, Ella. So yeah, that's true, right? So let's look at the second question. True or false? Taking on an adjustable rate mortgage can cause monthly payments to fluctuate. And this is true, right? Because when you have an adjustable rate mortgage, your interest rate might be adjusting. So then that can cause your payments to go up or down. Okay. And then this final question. True or false? You have to start paying down your student loan the moment you receive it. Can anyone answer this for me?
I mean, it's a good idea too, but like it's not like you have to.
And why is that, Sean? Why?
I mean, if you pay it right away, you don't have to pay as much money because of what's it called, interest. But like if you don't pay it, then you're gonna get a bit more interest, and you'll have to pay a bit more.
Okay, so true or false, Sean?
I think it's false.
Right, because the moment you receive your student loan, you're still in college, right? You just started college. So it doesn't really seem to make sense that you immediately have to start paying it when you're in college. Okay, and then this last question. So as a student, is it a good idea to open a line of credit as soon as you can when you turn 18? Why or why not? This is an interesting one because there's technically not a right answer, but you could back one up. So can somebody let me see. Okay, Sean.
So you can get a better credit score.
Okay, yeah. What would be a good reason why you shouldn't open a line of credit? Can anyone think of one? The moment you
Because
turn
you'll be
18?
too inexperienced.
Right. All right, thanks, Sean. So you remember, just by the way, try to raise your hand before speaking there so we give everybody a chance. But let's get back to our presentation. So a lot to do today. We're first going to look at the role of investing in personal finance. Then we're going to look at types of investment vehicles. Finally, we're going to look at retirement planning before we go on with our investment simulation game. And we're going to see who's the top investor in this class. Okay, so let's start with the role of investing in personal finance. So we have a quick discussion. So I hope I see a lot of hands raised so we can talk about investing together. So my first discussion question is, what is investing? Like, what is your definition of investing? Harrison?
Putting something you feel like is important and trying to get. So it's kind of like it's investing is kind of like a goal, and you're trying to put things in so then you get to that goal. Because investing isn't just making money, it's also like you can also invest in yourself, your hobbies, stuff like that. So
Okay.
That's why I say that.
Yeah, that's fair. That's fair. Esther?
For me, investing is like taking money you receive and using it on things that can benefit you in the long run.
Right. Good answer. Iris.
Basically, like maybe like if you think like a company will be like really make a lot of money later on, so like you can invest your money to help like that company, and then later you can get like a lot more, I think.
Yeah. Yeah. And then Sean.
Putting your money into something and hope it grows.
Okay. Yeah. Harrison, is that another hand or was that just from earlier?
I got lower.
Yeah. Okay. All right. So yeah, a wide range of definitions, all kind of pointing to the same direction. So that's good to hear. And then my second question is, why is it a good idea to invest? And this should be pretty straightforward, right? Sean.
So you can get the money you need or the goal that you want.
Okay. Yeah. Why is investing a good idea as opposed to some of the other things we've learned? Nav.
Why is it a good idea to invest? Because that when you invest, you like put in money into the like stock market, for example. But what it does is that it just keeps getting your money up. As more people buy the stock and more people buy into it, your money value goes up. And sometimes it can outrun the rate of inflation, but other times it can't. And sometimes your money will go down, but it's a risk to take.
Yeah, you hit on a key issue there, which is inflation, and we're going to be talking about that more. So yeah, good answer. Dante.
If what you invest in like kicks off, then you can make a lot of money very fast.
Yeah, exactly. And Harrison.
Because it's a way to make money by just not doing anything. It's a lot of risk, but if you do it correctly, you could just make money by just sitting there.
Yeah.
as
Yeah,
one
and it
would
doesn't have to
say.
be a lot of risk. There are ways to reduce risk as well, and we learn.
There's a lot of different type of strategies. Like there's a strategy where you buy when it's low and you sell when it's high, and continuously do that, so then you continuously gain, not lose.
Well, that's not exactly a strategy. That's just like the general idea. But you're thinking more of trading. That's more trading. When it comes to investing, we're thinking more long term. So oftentimes there's rarely a time that you sell. At least you're not trying to buy low, sell high. You're not trying to time the market. And we're gonna get into that a bit. There's this key difference between investing and trading that we should know. So let's continue. That was a good discussion. So understanding investing. So in the most basic terms, in the most general terms, investing is the act of devoting one's resources to something with the expectation of a worthwhile result. So I'm sure that many of you have already heard of the word quote unquote like investing used in like non-financial terms. So like, for example, like, I invested a lot of time to study for the upcoming physics exam, or, he invested all his effort in planning the graduation party. That's necessarily finance, but, it's still using the word invest correctly, right? Well, in finance, investing is the act of allocating money with the expectation of generating a return, or essentially, a profit. So in the context of personal finance, individuals usually invest in assets that are expected to rise over time. And also, by the way, feel free to raise your hand if you have any questions. Lower your hand once you've asked your question, or you've answered a question, just so I can keep track and make sure that that's not a new hand. And also feel free to send messages to Matthew, and then he'll try to contact me. Nav and Harrison, are those questions? Okay. Yeah. So why should you invest? So the simple answer to this question is that investing builds your wealth. Yeah. So I can think of 3 more nuanced reasons to support why we all need to invest. So firstly, and this was a point that Nav hit on, saving isn't just enough to beat inflation. Remember, we were talking about how savings accounts and all these bank accounts usually had pretty low interest rates. So saving isn't enough. So inflation usually outpaces the low interest rates of checking and savings accounts. Meanwhile, investing can yield really high returns that beat inflation. So it makes it much more effective than saving. Then the second reason is investing utilizes the power of compounding. So remember on Wednesday when we were talking about the story of the chessboard, when an investment generates earnings that are reinvested, those earnings then go on to generate their own earnings. So investing over a long period of time leads to a compounding of wealth. So you can utilize that power of compounding on your side. And then finally, investing is the best way to reach your financial goals and plan for a good retirement, right? When you grow your wealth, you're able to achieve more, you're able to do more, and all that. Okay, starting to invest. So because the power of compounding is only powerful over time, right? It's not powerful over a short period of time, but over a long period of time. We should maximize its power by trying to get it started with investing as early. Get started with investing as early as possible, right? So here's an example that really illustrates the power of compounding. So let's say I decide to place $200 into my usually it's called a brokerage account, where a brokerage account is what you use to invest. So let's say I invest $200 every month for 10 years. So I don't know if you have $200, if you're able to set aside $200 every month, but if you do that for 10 years, and let's say you get a 6% annual average annual return, which is honestly quite small. Usually you can get a lot more from your investments, but it really depends, right, on what you invest in. But 6% is, kind of middle of the road. It's not too bad, but not too good either. 6% average annual return. So then in total, by the end of 10 years, you would have invested $24,200. But guess how much you would make? You would make $33,300 $33,300 in total. So just from $200 every month in 10 years, you would have had $33,300. And basically you would have generated $9,100 from nothing, out of thin air, or rather from investing, right? So that's the power of compounding interest. That's what was able to occur over 10 years. So when you're 18, you'll be able to open your own brokerage account. So in such an account, you'll be able to deposit money with a brokerage firm that then places trades on your behalf. And here are some popular brokerage firms that individual investors use. I don't know if any of you have heard of these, but there's, Ameritrade, Charles Schwab, Fidelity, Bank of America, Wells Fargo, and a whole other one,
I know Fidelity.
I know Wells Fargo and Bank of America.
Okay, Matthew, what brokerage firm do you use?
I use TD Ameritrade. So does my dad, but my mom uses JP Morgan. So a lot of the banks have their own brokerage, but I just use TD Ameritrade.
Yeah. I use TD Ameritrade as well. So let's keep going. So let's now look at types of investment vehicles. And this is going to be really important because you're going to want to know this for the investment game. Because a lot of what we're learning right now is going to apply immediately to the investment game. So types of investment vehicles. So let's start with the most basic and the one that most people are kind of familiar with, hopefully, stocks, right? So let me, hold on, I have to reshare this so I can share the sound. And let me know if it doesn't play.
What is the stock exchange and how does it work? The stock exchange is nothing more than a giant... What is the stock exchange and how does it work? The stock exchange is nothing more than a giant globally networked and organized marketplace where every day huge sums of money are moved back and forth. In total, over 60 trillion euros a year are traded, more than the value of all goods and services of the entire world economy. However, it's not apples or second-hand toothbrushes that are traded on this marketplace, but predominantly securities. Securities are rights to assets mostly in the form of shares. A share stands for a share in a company. But why are shares traded at all? Well, first and foremost, the value of a share relates to the company behind it. If you think of the value of the company in terms of a pizza, the bigger the overall size of the pizza, the bigger every piece is. If, for example, Facebook is able to greatly increase its profits with a new business model, the size of the company's pizza will also increase, and as a result, so will the value of its shares. This is of course great for the shareholders. A share which perhaps used to be worth 38 euros could now be worth a whole 50 euros. When it's sold, this represents a profit of 12 euros per share. But what does Facebook gain from this? The company can raise funds by selling the shares and invest or expand its business. Facebook, for example, has earned $16 billion from its listing on the stock exchange. The trading of shares, though, is frequently a game of chance. No one can say which company will perform well and which will not. If a company has a good reputation, investors will back it. A company with a poor reputation or poor performance will have difficulty selling its shares. Unlike a normal market in which goods can be touched and taken home, on the stock exchange only virtual goods are available. They appear in the form of share prices and tables on monitors. Such share prices can rise or fall within seconds. Shareholders therefore have to act quickly in order not to miss an opportunity. Even a simple rumor can result in the demand for a share falling fast, regardless of the real value of the company. Of course, the opposite is also possible. If a particularly large number of people buy weak shares because they see, for example, great potential behind an idea, their value will rise as a result. In particular, young companies can benefit from this. Even though their sales might be falling, they can generate cash by placing their shares. In the best case scenario, this will result in their idea being turned into reality. In the worst case scenario, this will result in a speculative bubble with nothing more than hot air. And as in the case with bubbles, at some point they will burst. The value of Germany's biggest 30 companies is summarized in what's known as the DAX share index. The DAX curve shows how well or poorly these major companies, and thereby the economy as a whole, are performing at the present time. Stock exchanges in other countries also have their own indices, and all of these markets together create a globally networked marketplace.
I didn't know Adidas was from Germany.
Yeah, I do.
Oh, wait, say again?
It said Adidas was from Germany, and I didn't know that.
Yeah, Adidas and Puma were actually, I believe, created in the same town in Germany. So quite interesting. But let me know if there's any questions about that, or make sure you can message Matthew as well if you need any clarification. But just to kind of boil it down, stocks are securities or financial assets that represent the ownership of a fraction of a corporation. So by owning a stock, you are entitled to a proportion of the corporation's assets and profits. As investors, you can buy and sell stocks on the stock exchange. Now, what this video was talking about, it was kind of referencing more trading. It was like, oh, you want to time the market, so you buy low and sell high. That's not necessarily what we're looking at. We're looking at more long-term investing, where we're buying and we're holding. We're not really necessarily looking at trying to get the best price out of it and immediately close out our position. So yeah. Well, let me know if stock exchange stuff is a little confusing. Oh yeah, and Matthew was mentioning to me. So yeah, this the YouTube creators from I believe the YouTube creator from that created this video is German. So they were talking about DAX, which is a German index, and we'll talk about indices more in just a tiny bit. But let's look at mutual. Well, actually, we're going to look at it right now. So let's look at Okay, let's look at mutual index funds. So what is a mutual fund? So a mutual fund is a type of investment vehicle made up of a pool of money collected from many investors to invest in a professionally managed portfolio of securities. So this graphic kind of shows it, right? So you give money to a mutual fund, and then you have, a manager who kind of manages that portfolio. So you're not the one picking the stocks. The manager picks the stocks for you. So you have like kind of already a custom built portfolio. So that's what a mutual fund is. An index fund is a specific type of mutual fund, or it can be a type of ETF, but we'll get into that a little later. But in this case that we're looking at, an index fund is a special type of mutual fund with the portfolio constructed to match the components of a financial market index. So what this means is that these index funds follow indices. And indices are essentially these already constructed, I guess, averages of stocks. So for example, you have the S&P 500, which is essentially the combination of 500 of the top companies in the United States. You also have the Dow Jones Index, which is a compilation of 30 of the top industrial companies in the United States. So that's what indices are. And index funds essentially allow you to invest in those indices. So these are not hand managed because the indices are already there. So there's no human trying to pick anything. Yes, Andrew.
I'm kind of confused about the investing in the stocks and everything. Like, how do you earn money from that?
So going back to what we were originally saying about investing. So when you, let's say I'm trying to, let's say I purchase a stock of Google or a share of Google, right? With the expectation that it's going to rise, and it does. So the value of the asset that I purchased rises. So then over time, if I do decide to sell it, then the money I'm going to get back from selling it was much more than the money that I put in. Right? So I've generated a profit. I generate a return.
Oh, okay.
Does that make sense?
Yeah.
Yeah. All right, perfect. So let's keep going. But also just to clarify, the other thing is you don't necessarily have to sell your stock. Like I didn't have to sell my share of Google. Like I technically already had unrealized gains. And that counts towards my wealth, right? When you see people like Jeff Bezos or Mark Zuckerberg or Tim Cook, like, and you look at their wealth, their net worth, and it's like absolutely huge, right? But they don't technically have all that money at hand. Like they can't immediately like buy something that's worth that much because a lot of their money is stored as shares of their company. They would have to sell that off, which would be probably a disaster. But so what I'm saying, Andrew, is that you don't necessarily have to sell off your share to essentially, get back what you earn, because technically the asset itself already accounts for your wealth. Does that make sense?
Yeah.
All right, perfect. So that's mutual funds, that's index funds. Let's look at ETFs. So an exchange traded fund, or an ETF for short, is a type of security that tracks a specific sector, index, or other asset, but can also be sold on a stock market, the same as a regular stock. So the thing with let me see. Okay, so yeah, ETF share prices fluctuate all day, so they're just like stocks where the prices can change all day. So as the ETF is bought and sold, it goes up or down. Meanwhile, mutual funds and index funds that are built like mutual funds are only traded once a day after the market closes. So those prices only change. The prices of index funds that are essentially mutual funds. Sorry, the prices of mutual funds and index funds that are a special case of mutual funds only change once a day. Their prices only change once a day after the market closes at 4 p.m., I believe. Right, Matthew?
Yeah, it's 4 p.m.
4 p.m., yeah. Whereas an ETF, its price changes all day. So the confusing thing here, and I hope you all understand, is that index funds can be mutual funds or ETFs. There's kind of two types of index funds. Index funds can be mutual funds where they only change once a day after the market closes, or they can also be ETFs where their prices change all day. but they're still index funds. They still track indices. Does that make sense?
What's important to know is that an index fund is usually a large amount of cash and tracks a large sector or a large amount of money. So normally you can't directly buy into index funds like the S&P 500 or like the Dow Jones. You have to either find a mutual fund or an ETF for that. So index funds like the S&P 500 and Dow Jones, they track a large amount of companies and usually can be based to look at an exact sector. So for example, one of them would be NASDAQ, NASDAQ, which tracks the technology sector overall, right? So index funds, what's important to understand, they're large sums of money and they track large sectors or a large amount of stock or even the entire economy.
Well,
So
Matthew, I want to clarify here. Those are indices. You can invest in index funds.
All right, sorry, my bad. I guess I got confused. They do sound really similar.
Yeah, no. But no, I was actually gonna go into this. So here, let me give 3 examples of ETFs. So here's the first one. So the Spider S&P 500 ETF, which simply tracks the S&P 500, 500 of one of the of mostly the largest public American companies, right? So if you simply want kind of a snapshot of the American economy, you don't want to invest in a specific company, then the S&P 500 is the index that you want to invest in. So therefore, you invest in the Spider S&P 500 ETF. There are also more industry-specific ones. So for example, the iShares Global Clean Energy ETF, which tracks companies in the renewable energies industry. So for example, if you think that renewable energies are the future and that companies invested in global in clean energy is the future, then you might want to invest in this, which is something that I'm looking into. So yeah, and another one that I've been looking into is the space industry. So here's an ETF, Procure Space, that tracks companies in the space industry. So yeah, pretty interesting stuff. So, and this is really important, I guess, just for your own sake, but also for the simulation game, is that the thing to know here is that what makes mutual funds, index funds, and ETF special is that they're automatically diversified, right? Meaning that you take on less risk than if you were to invest in a single company. And what that means is, if a single company that you invested in fails, like if I hadn't just invested in Google and, suddenly something bad happens to it and its share price drops, then I lose a lot, right? But if a single company in a mutual fund, an index fund, or an ETF that you invest in fails, then the decrease in value of that investment vehicle would be significantly smaller. So for example, if I was invested in Spider S&P 500 ETF and Google suddenly has this disaster that happens and its share price drops, the S&P 500 is going to dip, perhaps. I think it would probably dip because Google's market cap is pretty big, but it wouldn't be as bad as if I had just invested in Google. So remember, when you diversify, which ETFs automatically do, which mutual funds and index funds automatically do, then you're reducing the risk, right? So you can win big, but you can also lose. So you can win big and you can lose hard if you invest in single companies. That's what kind of risk is. And let me check the chat here. Yeah, okay. All right, so does everybody understand what we just went over with exchange traded funds, mutual funds, index funds? All right, sounds good. Feel free to ask any questions anytime, and you can shoot messages in the chat to Matthew as well. Okay, so a few other investment vehicles that are important to know and important to know for our investment simulation, bonds. So bonds are fixed income investments that represent loans made by an investor to a borrower. So the investor essentially loans money, which is also known as the principal value to a borrower. So this borrower, usually a corporation or a government. So then the bond then essentially represents an IOU. Then the investor receives periodic interest payments over time before receiving their principal value back at the maturity date of the bond. So I don't know if that was confusing or not, but essentially, let's say Matthew is the US government, okay? And Matthew needs money. The US government needs money. So then he creates these bonds, and I take him up on his offer. I take the government up on the offer. I say, here, I will pay for this bond. I'll pay, I don't know. So basically it's a bond, and its maturity date is, say, like 5 years, right? So what happens is I give Matthew the money, he gives me the bond, and then Matthew will be paying me, depending on the interest rate of the bond, he will be paying me these periodic interest payments as I hold on to the bond for 10 years. And then at the end, Matthew will give me my original money back, and then the bond is fulfilled. The bond has matured. That is kind of the primary market of bonds. There's this whole other thing with secondary markets where bonds are usually sold, but that's not necessarily something we have to get into. But just let me know if there's any questions about bonds here, but that's kind of the general idea. Let's see. So another investment vehicle is commodities, which are essentially basic goods used in commerce and most often used as inputs in the production of other goods and services. So examples of such commodities include grains, gold and precious metals in general. I believe someone mentioned that earlier this week. Oil, right? Natural gas. These are all quality examples of commodities. And the thing is, these are quite risky as well. They're just like kind of stocks. They can jump all over the place. And you might be given you're given an option to invest in commodities in the game, I believe. So do it at your own risk. Okay, so the final part, let's look at retirement planning. So I have a quick question for you all, a quick discussion question. Feel free to raise your hand. Try to get more people to talk here. So imagine yourself at retirement. What would be your ideal life? Jenny.
My ideal life would be a similar life that I have right now.
Okay. You satisfied right now, Jenny?
What?
Are you satisfied right now?
Yeah.
Okay, that's fair. Sean, what would your ideal retirement look like?
I don't I'll be in like this little cozy cabin that's maybe like I don't know, like one bed, one bath to keep it small so I don't break my back while trying to clean it. And like 50% of the time I'll be laying in the couch playing something or watching TV. 30% of the time I'll be sleeping. 20% of the time I'll cook myself something good.
Okay. Dante, you want to seclude yourself in Alaska, right?
And I still do.
Okay.
Alone, far away from any neighbors.
Fair. Nav?
I'm gonna be in a 7-story house with 17 bedrooms, a couple of servants. I don't know. Big. When I retire.
That's quite the goal, Nav. You're gonna have to make some quality investments to get there. But sounds, hey, look, very ambitious. Brandon?
I want to live in a small apartment where in a very large city, so I also want to have my own chemistry lab, and I'll probably be playing chess online most of the time.
Yeah. Look, a small apartment. Look, that small apartment in a major city might just be as expensive as Nav's 7-story mansion, just given real estate prices and where they're going. But yeah, these sound pretty interesting. So let's continue. So how do we get there, right? That's the question. So to have a fun, comfortable and secure retirement, a strong financial cushion rather is necessary to fund it, right? So planning for retirement starts with recognizing your retirement goals and how you will meet them. And you all kind of took that first step, right? Like, what do you with like, where do I want to be with retirement? But your answer might change over the years as you grow up. And the key thing here is, and something that's important to remember for the game, is that conservative investment is key for planning for retirement. So I don't know how many of you have watched Wolf of Wall Street or other depictions of Wall Street in like Hollywood or just any shows, any movies. But oftentimes they talk about, quickly buying and selling, trying to time the market, trying to be a genius. And that's not conservative, right? They're trying to gun for specific companies or gun for specific, commodities and all that stuff. That's not what you want to do when you're conservatively investing. You want to play it safe, right? You want to reduce the risk so that, you might not be getting the highest returns, but you don't want to lose out. You don't want to lose your life savings, right? Okay, so that's conservative investment there. Something important to keep in mind for the game. And then finally, we'll look at retirement accounts before we jump in the game. I think there's one other thing, but so retirement accounts. These are usually used by individuals to save and invest for retirement. So slightly different from brokerage accounts where you're just doing normal investing. These are different. So different types of accounts are offered by different institutions and provide different tax advantages. We're not going to go too much into tax advantages, but I'll just provide two major examples of retirement accounts. So the individual retirement account, or the IRA, is offered by financial institutions, usually banks. When you place money into your IRA, you're able to choose from a variety of different financial instruments, like stocks, bonds, ETFs, mutual funds, etc. Those are IRAs. A 401k plan is another type of retirement account offered by most U.S. employers. So if in the future you work somewhere that offers a 401k plan, you'll see that part of your pay, part of your salary gets automatically siphoned off into your 401k. And then your employer will match at least part of your own contributions. So then you'll be able to pick up, you'll be able to pick what you invest in for your 401k plan, kind of similar to an IRA in that regard. There are some more complexities with tax codes, like for example, Roth IRAs, and all that and how they differ. But not necessarily something we have to get into in this course, but if you're interested, definitely something to look into. Okay, the final thing we're going to talk about is effective long-term investing. So here is probably the most crucial part that everybody should know before we start the game. So the question here is, what's the most effective investment strategy, right? So I have two things I want to offer. These are tried and true. So the first thing is buy and hold. So as investors say, time in the market beats timing the market. So trust the power of compounding interest over time. We're not trading, right? We're not trying to buy and sell really quickly to try to earn a quick profit. We're investing. We're establishing a position in the stock market, or not even the stock market. We're establishing an investment position, and we're waiting out for the long term. So that's what buy and hold means. And the second thing is diversifying to manage risk. So you should look into, for example, ETFs, index funds, mutual funds, rather than individual securities, rather than individual companies, right? Just so you manage your risk. Yeah, so there's that. Let's do the investment simulation game. This is going to take a while, so we're going to have to try to get through this as fast as possible. So this game is called Build Your Stacks. So what this is you're essentially simulating 20 years of investment decisions in 20 minutes. And we might just be on time for this. So some tips here is you should learn the difference between different investment assets. Remember, high risk, high reward, low risk, low reward kind of. So make sure you can manage your risk, make sure that, things don't blow up in your face. And the other thing that you should do is make sure that you're managing, it might be tempting to put all your money into investments, but you should also manage a bit of money in your savings account as an emergency fund, because the game is going to throw you a lot of unexpected expenses. And it's really important that you keep money in your savings account to make sure that you can pay off those emergency expenses. Because if not, you're gonna have to sell off investments. It's a whole mess. So let's get into the game. As I'm pulling this up, feel free to raise your hand if you have any questions about what we just covered, or you can send a message to Matthew as well.
Yeah, also, this is just like a tip for the future. It's pretty much recognized that high risk always equals, or you can say that high risk doesn't always equal high reward, but low risk almost never equals high reward. So if you see someone that's promising you, or like later on, you'll see these people, if they're promising you low risk, but with really high reward, you pretty much can know that it's a scam. So I don't know if you guys pay attention to cryptocurrency much, and that's too complicated, but there was basically a website with people saying that if you invest with us, then absolutely no risk, and we'll 100 times your money. So we'll make your money go 100-fold. And that's a very, very obvious example of a scam because, like we said, high risk, high reward, and low risk, low reward, right? So those are just some really easy ways to recognize if there's scams or if something's not true.
All right, yeah, thank you, Matthew. So check the chat. I linked the link to the game. Make sure you press play in a group and then you enter the group code here, and then make sure you click ready, and then we'll be able to start.
What's the group code?
The chat.
The chat lab.
It asks us to put our name in again. Should we just make up one or like put our actual name?
No, put your actual name because we're going to be playing this group together.
Make sure once you're in the game that you click ready so we can start. And I only see 14 people right now, so make sure everybody is getting in.
Can we start?
We're still waiting on a few people. So we start as a group here. So let me share my screen here so we can actually see. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, so 22. All right, last call for people entering the game because we're going to start in perhaps 30 seconds. So
when you say play in a group and you say join group, you have to put your group code into the join a group. So you press the join a group button. Or if it's not working, try reloading your page. That should work.
Wait, Matthew, are you in? Oh, yeah.
Oh, yeah, I'm in.
Yeah, I see you. All right, everybody make sure they're ready. We're going to go ahead and get started. Angela, you good?
What?
Angela, it says you're still not ready.
Oh, yeah.
I entered the group code and I put my name in. I'm pressing join group and it's doing nothing.
Okay, maybe retry. Wait, no, I already see that you're in. Oh, no, you're in. You're ready. You're good, right, Angela?
Yeah, I just didn't go through the things at the beginning.
Okay, let's start.
then.
Make sure to ready up everybody. I'm not too sure what's going on right now, but I guess you guys are reading something regarding the game.
Yeah.
Oh yeah, we're
Make sure you're
supposed to
present
read.
through everything.
Reading it regarding the game.
All right. Let's get started.
How do you play?
I guess you just spam deposit account or something.
How do you play this?
Question.
I don't know. I'm very confused too.
Matthew, can you clarify?
All right. So
Like how?
basically, on the left bar, you will see what's going on. And if you read the instructions at the beginning, it should teach you guys. But basically, what's going on is on the left bar, you see the money that's coming in. And then what just happened was they told you what a savings account was, and you had the ability to deposit your money into the savings account. So how that would work is you would press deposit, and then you would type in the amount of money you want to put into the deposit account, and then it would generate interest. And when you want to take it out, you can press withdraw. So this time, this new one is a certificate of deposit. And if you want, I can just read it to you guys, where basically it's what we learned, buying a savings certificate with interest for a fixed period of time. And then you will see the instructions on how it works if you read everything. So if you withdraw your money before the term is up, you'll have a penalty. How long your money will be tied up, it will be 3 months to 5 years that you get to choose. The longer the term, the higher the interest rate. And to buy a CD, second to last one you see, to buy a CD, click buy, then select one and deposit your desired amount. So you'll see an image there. There's the buy button and you press the amount of money you want to have. And then your CD has reached maturity date and the green circle will fill, then you can collect without a penalty. But if you want to collect it before the circle is filled, then there'll be a penalty fee of 10%, meaning 10% of your money will be taken as a penalty. So that's how it works.
I don't know what I did, but my new net worth is $12,000.
I guess you just like spam it into your savings account.
Yeah. Well, there's gonna be more options as we continue, right? So just hang tight and you'll see the other options open up for you. And all right, let's go back.
Apparently, there's computer players.
How do you invest with the index fund?
Just spam it in there. Just wait for the timing. Oh, the computer's first, which means we're doing terrible.
Well, the computer has a specific strategy, and you'll see what it is once we're able to see everybody's portfolios at the end.
Can you start the next part? Thank you.
I have to leave. Is that okay?
Yeah, that's fine. We are going a bit over, but if you would like to stay, to finish up the game, that's fine too. And thanks for coming, by the way.
I also have to leave.
Oh yeah, no worries.
Okay, bye.
All right, looks like we finished up. So if you were curious, we used real stock data from 1982 to 2002. And these were actual companies here that you invested in that tracked real prices. So congrats to Thalia, who actually beat the computer. It was very surprising. And then we can see each other's portfolios here. Thalia had, oh, that is quite the portfolio. That is very interesting. Didn't think that would work, but hey, if it works, it works. So as you can see, what the computer does is essentially what you should do. Index funds, go all in on index funds, right? Because you want to diversify and everything. But that's essentially the game. I hope you enjoyed it. And that was essentially the class as well. So thanks for coming. And I hope you learned a lot this week. And yeah. See ya.
Thank you.
Leave now, leave. Thank you so much. Now, bye.